Hello everyone. In today's video, I'm going to talk about your income tax for the 2021. And by 2021 means whatever you earn between January 2020 to December 31st, 2020, and you will be filing typically in April 2021. Most likely before April 15, 2021, but you can also file an extension. So with that clarity about the dates for which this income tax is covered, and before I start discussing more details about the tricks and tips to reduce your income tax, I want to clarify that I'm not a CPA or a licensed CPA for that matter, and this discussion and whatever figures here are, they can be totally wrong, they can be incorrect, they could be misleading, and you should consult your certified CPA for all your tax related formal questions. This discussion is just as if two friends are talking. I'm your friends, I'm entertaining you, I'm bringing some points that I and you can discuss in an informal way, and it does not imply any fixed figure, and some of them could actually be wrong. So go back and check your IRA guidelines, IRA papers. They are a little complex, but they are accurate, and consult your CPA again for any formal discussion about your tax questions. So to start with, let's discuss, and again, we want to first, you should know that how you calculate your tax, and I will broadly discuss only two categories. I'm expecting most of you are filing as married, filing jointly, because there is a tax benefit about it, but you could also file as single. The married filing jointly for 2021, your tax for the first 19,750 is 10%. But it's not that you start paying 10% right on your first 19,750, and this limit is 9,875 for single. What you have is called a something you call a standard deduction, which is 24,800 for married filing jointly. So whatever your income is, for example, if you have a 60,000 let's say you earn 60,000 income, then first of all you need to reduce it by 24,000 at 800. It's called a standard deduction. There used to be two categories of deductions. One is called a standard deduction, and other category is called something like where you take deduction from your home loan and so on and so forth. We will not discuss that, because with the new rule, and this limit is very high, it gets very cumbersome. The other way is very cumbersome. So this big means that you have an income of, it will be calculated only upon 5, and this is 35,200 if you have a 60,000 income. Now, how if you, let's say, do 60,000, then, and you do nothing else, then your income will start, your income tax will be calculated on this amount, and the first 19,750 will be taxed at the rate of 10%. That you will be paying 1,975 on the first 19,500, and from 19,750 to 80,250, which is in your case, you will be taxed at 12%. So those limits, and then from 80,000 to 171,000, you will be paying tax at the rate of 22%. And I'm not going to discuss anything beyond that, because I hope if you have that kind of income, you are smart enough and you have some good people to you can pay and you can get their services about it. So that brings me to one good question, is that if your income is, let's say, 80,250 and plus 24,000, and 800, which is roughly 104,800, your taxes are very reasonable. I would say any tax rate of 10 to 12% is very fair enough. We should feel happy about contributing to the tax. And that's, I'm talking about only the federal tax. I'm not including any state tax which will be in addition to these taxes. So that being said, now how you can further minimize any taxes, and that is the list for those things. And usually you should start worrying primarily if your income is something like 80 plus 24,800 or something like 104,000 or 104 or 105,000, because then you jump into the tax bracket of 22%, which starts getting substantial. So this is a very rough idea of how you are looking at your income and your taxation. So the first thing that you should do is the 401k contribution, and in 2021 you could contribute as much as 19,500 in 401k. So what does that 19,500 do? That the more you contribute to 401k up to a limit of 19,000, but you reduce it from your income, and then your income is calculated on the rest of it. So let's say I'm going back to, I have already put out some of those equations. What is your total deductions that you can take? So 24,800 for standard deduction, and then on the top of that, for example, if you had a 60,000 income, then you reduce your standard deduction, and then from here you could reduce 19,500, and that will be equal to 700 and then 5, and then what? You will be taxed only on 15,700, and that will be at the rate of 10,000. You will be paying $1,570 of taxes. That's to give you a very rough idea, to give you of what's happening. Now, should you contribute completely 19,500 is a good question to ask. So what happens is, this one thing you need to keep in mind is that whatever you contribute to your 401k at 59.5 years or later, you start withdrawing it. And when you withdraw it, that is counted as your income. And then you will be paying, you will be filing your income tax at that point of time. And then this, whatever you withdraw from this 401k every year will be counted as income. And hopefully you will be withdrawing a much smaller amount every year, maybe like total 40k, 50k, and you will not be paying any tax. The problem is if you start maximizing it, especially very early in your career. For example, if you are 30-year-old and you start contributing $20,000 every single year, and by the time you are 60, so 10 years you will be contributing something like 20 into 10 or $200,000. And 30 years you will be contributing $600,000, and that will have become because that will be invested into your 401k account that can double or triple. So you are looking at millions of dollars, amount of $1 million or over. So, and then if you want to withdraw that money between 60 to 70 years, let's say, then you are looking at a 100k or more of withdrawal, and you certainly will be paying taxes about the same rate as today. So over contributing has its another problem, that you are postponing your taxation for some later period in time, but that amount itself could become very big, and then you can end up paying a very big amount. So I will not say that contributing to 19,500 is a very good idea, but if you have not saved anything till late in your career, you are already 40, 45-year-old or maybe 50-year-old, and you have not saved anything in your 401k for whatsoever reason, it's time to contribute. If you can contribute more into that, make sure your retirement account has like 200 or 300k saving in total, so that you can contribute, withdraw it in next like 4 or 5 years, between let's say 60 to 65 or maybe 65 to 70. So that is one point. So what I would say is that a 9.5K is a reasonable amount that you should be contributing to 401K. With that $9,500, you are looking at in 10 years, it will be like 100K, and in 30 years, it will be like 300K, which is a reasonable amount of 401K, and that 300K could actually swell to something like 600K or something, because those amount increases roughly about the same rate as the stock market, and in the long term they always grow, and that could become double or triple or whatever. So 9.5K is a reasonable amount, and that brings me to the next topic of, let's consider the healthcare saving account. What is HSA? This is something that your employer provides, and if they don't provide, you probably do not do this HSA. So HSA is a saving account which you contribute to your employer's sponsored HSA account, and then you use that money whenever you go to a doctor, visit a doctor, and you pay your copay or you buy some medicines prescribed by them. So the limit for that is $7,200, and in theory you could deduct that much, but frankly I would not put that much of money into it. I typically have kept here 2.7K. That's what I do. I put like $50 for every bi-weekly paycheck, maybe a little more, $100 per bi-weekly paycheck, maybe $200 a month or $2,400 per year. Probably you should contribute even less than. I put an amount of 2.7K into HSA. If the employer does provide you this facility, put some money into it, but don't overdo it. Keep it very close to what your yearly HSA spending is going to be. So with that said, let's say 24.8K, 9.5K in your 401K account, and 2.7K into healthcare saving account. We are looking at 37K. The first 37K, you don't pay any tax. And let's say if your income is 60K, then it's 60K minus 37K. It's like 23K. You will be paying 10% of tax on the first 19,750, which is 1.975K, and the rest of 3250 you will be paying 12% of tax, which is I've calculated previously $390. Just to give you an idea. And moving forward, what are the other ways you could save in taxes? So IRA is another way you could contribute to. IRA and 401K. 401K is something that your employer provides. So your employer, but in addition to your employer, you could have another account, IRA and Roth IRA, and we will discuss both of these two briefly. Both of them have a limit of $6,000. That's the additional amount you could contribute. Now, whether you should choose IRA or Roth IRA depends upon do you actively invest into stock market, and do you expect that to grow substantially. If you invest substantially into stock market and you expect your investment to grow, you should be doing Roth IRA, which is you invest into Roth IRA $6,000, and then that amount you do not get any immediate tax benefit, but whatsoever gain in that IRA happens because of your investment in the stock market, when you withdraw, you don't pay any tax into the withdrawal. So that is what Roth IRA, which I do, because I also, if you know me, I invest a lot in stock market, so every single year I have $6,000 IRA. One more thing, you can have $6,000 IRA account for yourself and another $6,000 for your spouse. Same thing with IRA. So the total sum of the IRA and Roth IRA cannot be more than $6,000, and this also phases out if you have your modified income, gross income is more than $198,000. So you are out of those two things if your modified income is crosses a certain threshold. So I'm hoping that whatever I am telling is applicable to most of the viewers who do not fall into this higher income category. The limit was $196,000 2020, and probably that limit has not been formally announced for 2021, but it's likely going to be $198K, and hopefully you qualify for that. So make sure you take advantage of this. Healthcare saving accounts, I already covered it. Standard deductions, I covered it. There are few special cases that I wanted to discuss into it. If you would be, again, the things get very complicated because of so many rules and because so many variations, permutations and combinations. Each individual's case is very different. It's very hard to pinpoint with precision about every single case. But I wanted to give you a certain ideas to where to look for and how to get a feeling of qualitatively, not if precision with precision or quantitatively, qualitatively what you should be doing. So another was a 457B plan. I have not, many companies that you work for, they provide this kind of account which is similar to 401k with a combined limit with 401k and 457B same as 19,500. But in this plan, you could withdraw that money earlier than 59 and a half years. So if your employer provides this plan, make use of it. And that brings us to the next two things. It's an Escort. So if you are an individual who work like a consultant or a contractor, or if you have a firm, then that firm can be an Escort. And in an Escort, what you do is that Escort receives the money for the contract job or consulting work or whatever business you do into their Escort account, and from that account there are two ways you could have. You could have your own job plus an Escort, or you could have a single Escort. You get your money into Escort. Then the benefit of the Escort is you could show your expenses into Escort. For example, for your travel to a business, for your travel expenses can be shown. Some of your home expenses, home office expenses could be deducted. For example, you could share your home office between office and your home. You could deduct a part of it. So those are the kind of deductions you could show in your Escort, and then you do not pay tax on those deductions. And then you can pay to yourself from that Escort. Or if you are working into some other firm in a regular W-2, then you could use this profit or losses to merge with your income. So this is some of the benefits. Again, this is going to be a highly individualized, and advices for that. What the advice is, you should consult your CPA or a financial advisor. I'm not a financial advisor and I'm not a CPA. I'm just bringing it just to bring the point very clear. I am not giving any financial advice. I am just discussing it as a friend for your entertainment. Solo 401k is another option for you. If you are a very high net worth individual, your income is something like 200k or above, and you want to postpone your tax paying, you could use solo 401k. I do not remember right on the top of my head, but the limit is similar to 401k, but the income limit, the limit to which you could contribute is much higher at like $50,000 or something. So those are some of my points. One last thing was the earned income credit. If you have children, like 2 children, then whatsoever income tax is calculated on your income, a part of that income gets reduced because you have dependent. So that also comes into play into your income tax. Now, a few more things about 2021 with a special reference to COVID-19. I hope you got $1,200 of the CARES Act payment. So that part, that $1,200 does not count, is not counted as your income in 2020. That $1,200 is given back to you from whatsoever income tax you paid, or even if did not paid in the income tax you filed in March 2020. So that is another thing that you need to keep in mind. If you have any unemployment income, that is certainly calculated as your income. So including the $600 per week that you got if you were unemployed. So I think this probably is pretty much I wanted to cover. If you have more questions, just put it into the comment section and I will try to answer, of course, not as a financial advisor, but as for your entertainment. Thank you. Bye.